Best shape I've ever seen a company. Pipelines exploding across every industry. That's Bill McDermott, CEO of ServiceNOW, speaking at Davos just days ago. Meanwhile, his stock is down 43% from its highs. So what's going on here? Is McDermott delusional, or is the market missing something massive? Let's break it down. January 2026 has been a bloodbath for software stocks. The IGV software, ETF, is down 7% month to date. Morgan Stanley's SaaS basket is down 15% year to date. And over the past 6 months, $4.2 billion has flowed out of IGV alone. The casualties, Intuit down 16%, Adobe down 11%, Salesforce down 11%, and ServiceNOw down 43% from its 52-week high. So what triggered this panic? January 12th, 2026, Anthropic launches Claude Cowork, AI agents that can automate entire business workflows. Document processing, file management, task automation, Wall Street's interpretation, I will replace enterprise software. Jordan Klein at Mizuho put it bluntly. Many buy-siders see no reasons to own software, no matter how cheap or beaten down. The narrative became simple. If AI can do the work, why pay for the software? But here's what most people are missing. This selling isn't about fundamentals. It's about mechanics. When investors panic and sell IGV, the ETF must redeem the underlying shares. That means ServiceNow gets sold regardless of its fundamentals, valuation, or outlook. The numbers are staggering. $494 million of outflows in a single week. That's 7.1% of IGV's total assets. $2.1 billion over 3 months, $4.2 billion over 6 months. This is mechanical selling, not a judgment on ServiceNow's business. And here's where it gets even more interesting. Look at who owns ServiceNow. Vanguard holds 8.13%. BlackRock holds 8.08%. Combined, that's 16% of the company held by just 2 passive giants. Total institutional ownership, 90.3%. What this means is simple. When IGV sees redemptions, these passive funds must sell ServiceNow shares proportionally. They have no choice. It doesn't matter if the company just posted record earnings. The selling is automatic. So let's look at the disconnect between what the stock is saying and what the business is saying. The stock says down 43% from highs, down 28% in 2025 alone, trading around 136. And the narrative is AI kills SaaS. But the business says something completely different. Revenue growth of 22%, RPO growth of 23%, renewal rate of 98%, and 29 consecutive earnings beats. Which one is lying? Let's dig into those Q3 numbers. Total revenue, $3.4 billion, up 22% year over year. Subscription revenue, $3.3 billion, up 20.5% in constant currency. Current RPO, $11.4 billion, beating estimates by 250 basis points. Total RPO, $24.3 billion, up 23%. Operating margin, 33.5%, beating by 300 basis points. And they raised full-year guidance to $12.84 to $12.85 billion. Enterprise deals, 103 deals over $1 million in net new ACV, 3 deals over $20 million. But here's the number that should make you stop and think. 98% renewal rate. If AI is killing SaaS, why are 98% of customers renewing? They're not leaving, they're expanding. Now let's talk about the McDermott Factor. This isn't some random CEO making bold claims. Bill McDermott has 40 years of enterprise software experience. At SAP, he grew market cap by 4x. At ServiceNow, he's grown it by more than 3x. His contract was just extended through 2030. At Davos, he talked about 1.2 million AI agents already deployed on the platform. He positioned ServiceNow as the AI control tower, the orchestration layer for enterprise AI. Think about what that means. ServiceNow isn't competing with AI agents. It's orchestrating them. Every enterprise will have dozens, maybe hundreds of AI agents from OpenAI, from Anthropic, from Google, from internal teams. Someone needs to manage the traffic. Someone needs to enforce governance. Someone needs to connect these agents to actual business workflows. That's ServiceNow's bet. They're not the agents. They're the AIR traffic control. And they're backing it up with action, a deep partnership with OpenAI integrating GPT 5.2 directly into the Now platform, enterprise-grade security, native integration, AI capabilities embedded in existing workflows with zero friction adoption. Now, here's where this gets really interesting. We've seen this playbook before. Remember semiconductors in 2022? The sector peaked in 2021 during the chip shortage mania. Then in 2022, SOXX crashed 35%. Nvidia fell 66% from its highs. The narrative? Chips are oversupplied. PC sales collapsing. Data centers slowing. The party is over. Sound familiar? Then came May 24th, 2023. One earnings report changed everything. Nvidia popped 24% in a single day. Guidance came in 50% above consensus. Within a week, they hit a $1 trillion market cap. And the ripple effect? SMH jumped 8.6% that same day. AMD up 11%. Taiwan Semi up 12%. SOXX rallied 46% for the rest of 2023. One company, one earnings report. The entire sector repriced. The parallel to ServiceNOW is striking. Sector ETF under pressure? Check. IGV is bleeding just like SMH was. Massive outflows? Check. 4.2 billion, just like the semi fund saw. Lead stock crushed? Check. ServiceNOW down 43%. Nvidia was down 66%. Dominant narrative that the sector is dead? Check. AI kills SaaS versus chips are oversupplied. Visionary CEO positioning for transformation? Check. McDermott at Davos, Jensen at GTC. Upcoming earnings catalyst? Check. January 28th, 2026, 29 consecutive beats. Could number 30 be the one that reprices the entire SaaS sector? Now, I have to be honest about the risks. First, valuation. Even at 43% off the highs, ServiceNOW trades at around 83 times earnings. This isn't a value stock. It's a quality stock on sale. Second, federal exposure. DOGE cuts and government efficiency drives could impact federal contracts. Q3 federal was strong, up 30%, but uncertainty remains. Third, acquisition integration. The Armis deal at $7.75 billion is their largest ever. Integration risk is real. MoveWorks at $2.85 billion also needs to deliver. Fourth, AI disruption speed. If AI agents improve faster than expected, the orchestration layer thesis could be challenged. The Nvidia parallel isn't perfect. This is not financial advice. Do your own research. Position sizing matters. But here's the setup. Mechanical selling from ETF outflows. Not fundamental deterioration, 98% renewal rate, 29 consecutive beats, 20+% growth. The CEO says best shape ever, while the stock is down 43% from highs. The potential catalyst? January 28th, 2026. This video is for entertainment and educational purposes only. Nothing in this video should be considered financial advice. I am not a licensed financial advisor, broker, or dealer. Always do your own research and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results. Investing involves risk, including the potential loss of principal. If you found value in this analysis, subscribe for more undervalued AI gems. This is Oracle of AI. See you in the next one.